Hello, everyone. Welcome back to Getting Your Shit Together. I'm Neil, your trusted mortgage agent, and I'm here with my co host, Jerome. How's it going, Jerome?
Hey, Neil. I'm doing great. Thanks for asking. I'm also ready to dive into this next hot topic. I hear the Bank of Canada has given us something to talk about.
Oh, absolutely. They just made another move on 4th of September, cutting the policy rate by a quarter of a point. That's the third rate cut in a row. And so that brings the policy rate to 4.25%, and that nudges the prime rate to 6.45%. It's definitely got people talking, especially those with a variable rate mortgage. Those of us with a variable rate mortgage who were battered in the years 2022 and 2023 with the unprecedented hikes we witnessed. So this is a very welcome relief for us, the survivors.
Yeah, it's interesting. I mean, for anyone with a variable rate mortgage, this is good news in the immediate term. Your monthly payments just got a little bit lighter. Of course, depending on when your lender makes the adjustment, either immediately or at the end of the month, caveat. About $20 less, in fact, for every $100,000 you owe per month, just to make that clear. But Neil, you and I both know that there's so much more to the story. What's your take?
Exactly, Jerome. While the interest rates cuts are helpful, they do not necessarily make it easier to qualify for a mortgage. If someone is out shopping for a home or looking to refinance, the reality is that they might be limited to a 5-year fixed or at best a 3-year fixed to get the most out of their qualification. So while the payments might be lower, the borrowing power isn't necessarily increasing. And so there is a risk that they are locking themselves into a higher rate for longer if they are purchasing or doing a refinance right now.
Yeah, that's a great point. And with the economy slowing down, CPI is easing, GDP is flat, and job growth is slowing. It seems like we're in for more cuts. The fixed rate mortgages have been leading the way, and we have seen as much as 1.4% from the peaks as the bond yields have come down significantly.
Yep. Oh, yes. Bond yields are definitely something to watch. They have been decreasing, but still the gap between them and the fixed rates is quite a bit above average.
Yeah.
I'm assuming as demand for mortgages picks up from here, we could see more competitive fixed rates. But let's get into it. What should people be doing with their mortgages right now?
It really depends on where you're at. If you're struggling with the variable rates and those monthly payments are stressing you out, not knowing if they're going to go up or down, switching to a 3-year fixed could be a good move. At least you know what the rates are, and you lock in some stability without committing to a long-term rate that keeps looking bad if rates continue to drop.
Oh, yeah, that's never a good feeling. But if you got some wriggle room in your budget, sticking with the variable rate could save you more in the long run, especially if the prime rate drops by another 1.5%, like some are predicting. But it's a gamble, isn't it?
Definitely is. We've been gambling, us variable rate mortgage holders have been gambling for the last few years with the thought that rates weren't going to go up as high as they were. And now we're starting to see them come down a lot slower, kind of like gas prices. And so if they don't come down like you expect, you could end up paying more over the long term. That's why I think the 3-year fixed is a safe bet for a lot of people right now, especially if you're up for renewal soon.
Mm-hmm.
But better check the spread between the variable and the 3-year fixed before making any sort of a determination.
Yeah. And speaking of renewals, if your renewal is coming up, the 3-year fixed rate can give you some peace of mind. You get a bit of relief now and the flexibility to refinance or renew in a few years when rates might be even lower.
So, what about those people who have already locked into the fixed rate that's above 5%? They're probably feeling a bit of that FOMO right now with all these rate cuts.
Mm-hmm. They are, and it's tough. If you got more than 2.5 years left on your term, it might be worth looking at your options now. But breaking that mortgage early could be costly. It's a balancing act. You don't want to wait too long, but also you don't want to jump ship if it's going to cost you more in penalties. If you're lucky, you might be able to get away with just 3 months of interest cost as penalty. And that's as long as the 1 to 3 year rates are high. But if one waits longer, that might definitely not be the case.
And that's where getting personalized advice is key. Everyone's situation is different, and a one size fits all approach just doesn't work.
Exactly. Now let's pivot to potential home buyers. With rates falling, some might think about waiting to see if they can snag an even better deal down the road. But Jerome, what's the risk in that?
It's tempting to wait, but here's the thing. By the time rates bottom out, the real estate market could also be heating up again. We're already starting to see signs that some sales activity is picking up, and the fall season should be busier than it was last year, mostly because of the rates that have been coming down. And if the Bank of Canada keeps cutting rates, we might even see more buyers jumping in.
And that could lead to more competition, higher home prices, and less room for negotiation. Personally, I don't expect prices to shoot through the roof or markets to become crazy as the pandemic times. But we could see no condition offers come back soon enough. If one is serious about buying, now might be the time to start looking, even if the rates haven't hit the rock bottom yet.
I agree. Keep an eye on what's happening in your desired neighborhoods. The last thing you want is to start preparing when everyone else is jumping in, and that's when prices go up. You might miss out on your ideal home because of that.
So true. It's all about being proactive. If you're ready to buy, get pre approved now and stay informed about the market trends, that can put you in a better position when the right opportunity comes along.
And remember, folks, it's not just about rate. Look at the bigger picture. Your finances, your goals, how long you plan to stay in the home. Make sure everything aligns before you make that move.
Absolutely. So, whether you are a current homeowner or a potential buyer, now is the time to get your shit together and make a plan that works for you. And today, we are tackling a question that's on the minds of a lot of people. We already touched upon this briefly in our first part, but let's explore it a bit further. When is the right time to buy a home? Jerome, can you share your thoughts?
Neil, this is such an important topic. Buying a home is likely going to be the biggest financial decision the average person is going to make. And the timing can really make or break the experience. Whether it's the state of the market like we're in today, your personal finances, or even just feeling ready for that kind of a commitment, it all plays a role in deciding when to jump in.
Very true, Jerome. And what we want to do today is break down the factors that should go into that making that decision. We are going to talk about everything from market conditions to one's own financial situation. Because let's face it, buying a home isn't just about finding the right house. It's about finding the right time also.
Yeah. So let's start with market timing, which is often the first thing that people think about when considering buying a home. The market can be tricky. Sometimes prices are high, sometimes they're low, and it's hard to predict what will happen next. I mean, what have we seen over the last few years? But here's the thing. Trying to time the market perfectly is almost impossible. Instead of waiting for the perfect time, it might be more important to consider whether you're personally and financially ready.
Exactly. And there is only so much that you can control, right? I've had clients who waited for prices to drop and ended up waiting or missing out on years of potential equity growth. On the other hand, I've seen others jump in too quickly without considering their own readiness. And that can also lead to stress or maybe even regret later on. For sure, walk away from a deal if the price seems too high. One way to assess the price is to look at the long term price trend for the property and the neighborhood. And if it's above the calculated price based on long term appreciation, then walk away. Any competent realtor should be able to work that out for you. But do note that the market condition is only one piece of the puzzle.
And that's why it's so crucial to look at your personal financial situation first. Do you have a stable job and a steady income? Do you have enough saved for your down payment? And don't forget about the closing costs and the extra expenses that come with home ownership, like maintenance and repairs. It's about more than just scraping together a down payment. You need to be financially ready for the whole package.
And speaking of being ready, Jerome and I have put together a checklist to help you assess whether now might be the right time for you to buy. Let us walk through it. First up is stable income. Do you have a steady job with reliable income? Have you been in your current position long enough to feel secure?
Savings for down payment. Have you saved enough for your down payment? Ideally, this would be 20% of the home's purchase price to avoid the mortgage insurance. But even a lower percentage can work if you're prepared for the extra costs and you think saving up the additional amount is going to take way too long.
Closing costs. Have you factored in the closing cost? And this can be anywhere between 1.5% to even 4% of the purchase price. It includes things like legal fees, land transfer fees, inspection fees. And don't forget about the twice the land transfer taxes if you're buying in the city of Toronto.
Yes. An emergency fund. Do you have an emergency fund that could cover at least 3 to 6 months of living expenses? This is crucial in case something unexpected happens after you buy your home.
Have you calculated your debt to income ratio? Ideally, the housing cost, which includes mortgage, taxes, insurance, and condo fees, if there is one, should not be more than, say, 32 to 35% of your gross monthly income. Or maybe you have a way to bring this in line by generating income from your property.
We all know about this one, credit score. Is your credit score in good shape? A higher credit score can help you get a better mortgage rate, which could save you thousands over the life of your loan.
And think long term. Do you plan to stay in the home you're buying for at least 5 to 7 years? Buying a home is a long term commitment, and selling too soon could mean losing money in transaction costs. So think about realtor fees to sell, market fluctuations, and whatnot.
Yeah. Market conditions. Imagine all the people that bought at the height of 2021 who are thinking of selling today. Some people are taking a loss, but it's not easy to time the market. We've already talked about that. But are you aware of the conditions in your area, specifically the area that you're looking at?
Yep.
And are you prepared for potential changes in the interest rates or the housing prices?
Personal readiness. Are you emotionally and mentally ready for the responsibility of homeownership? This includes being prepared for maintenance, repairs, and ignoring the ups and downs of housing market after I made the purchase.
Lastly, professional guidance. Have you consulted with a mortgage broker or financial advisor to discuss your options and make sure that you really are fully informed? I think this is one of the first things that you need to consider.
Yeah, and so those were the 10 things on your checklist. If you can check off most of these items, you might be in a good position to start seriously considering buying a home. But if not, that's okay. It just means that you've got some work to do before you're ready.
Exactly. And if you're not quite there yet, Focus on what you can control. Build up your savings, pay down your debt, work on boosting your credit score if any of those things are an issue. When you've got these bases covered, you'll be in a much stronger position to buy when the time is right for you.
And you'll feel more confident as well. So if you're thinking of buying a home, use this checklist to help you figure out if now is the right time for you. Remember, it is not just about what the market is doing. It's making sure you're financially and personally ready for the commitment.
And if you're unsure where you stand, that's where we come in. We're here to help you assess your situation, explore your options, and make a plan that works for you. The right time to buy is when you're ready, not when someone else says you should be.
So true. So thanks for turning into this episode of Getting Your Shit Together. We hope you found the checklist useful, and we look forward to bringing you more insights in our next episode. And remember, if you're thinking about buying a home, take your time, get your finances in order, and reach out if you need any guidance. We are here to help you every step of the way. Thank you.